Hello, and welcome to the second part of our online lecture series. In this chapter, we're going to be covering the investing and financing decisions of a company and the statement of financial position. So what are we going to cover today? We're going to be talking about the activities and transactions that cause changes from year to year on the statement of financial position. And we're also going to talk about how do companies keep track of all this. As we mentioned in the last lecture, in case you didn't get to check it out, if at any point you're confused, pause, listen to a section over again. If you already know something, feel free to skip ahead. But what we really recommend, since in this lecture we're going to actually be getting to journal entries, is when we ask a question or we're trying to write something out, pause and try to write it yourself. Try to figure it out, see if you understand the logic behind everything, and then confirm with what we cover. So let's get started. What is the objective of financial reporting? So, as you may remember, we discussed that the point of accounting as a whole and financial reporting is to provide financial information about a business to help external parties make sound financial decisions. If you remember, COMM 217 is all about the external users, while internal users is going to be covered in COMM 305. So in order to do so, in order to provide this financial information, we have a conceptual framework that provides guidance in determining how useful accounting information is. So let's take a look at our conceptual framework. Every bit of useful financial information must have these two fundamental characteristics. If financial information does not have these two characteristics, the fundamental ones, so we're going to highlight this, they're fundamental. It's very important. They must be relevant. What does relevance mean? It means that it can influence a decision. It means that it has predictive or confirmatory value. So this means that you can use these financial statements to either make predictions about the future, or it would confirm past performance, and it would confirm your previous predictions. The other bit of information it must have is faithful representation, and this is very important. Information must be complete, unbiased, and free from material error. The word material is very important in accounting, and basically what it means is that it would influence your decision. So let's talk about materiality. If I go out and get my car repaired, and I tell them, all right, fix it up, and they tell me that it's going to cost $1,000 to fix my car. If they call me the next day and they say, oh, actually, it's not going to be $1,000, it's going to be $5,000 to fix your car. Well, that's going to be material. From $1,000 to $5,000, that's a big change. But if they call me to say, hey, you know what? It's not actually going to be $1,000, it's going to be $1,005. I'm going to say, all right, fine, $5. It doesn't make a difference. So materiality can change based on the users and based on the size of the company, but what you need to understand is that material just means that it would change or influence your decision. In addition to our fundamental characteristics, we have 4 enhancing characteristics. The first is comparability, and this is important too because we want to be able to compare the same company, let's say, over 2 different periods, so the same corporation over 2 periods, or to compare 2 different companies. And this is important when we're making decisions or analyzing companies. Verifiability, meaning that independent accountants would arrive at the same results, that the information that we're reporting can be independently verified. Timeliness, it's important that the information is provided in time to provide predictive or confirmatory value. It doesn't really help you if a company says, hey, here's our income statement for 5 years ago. That doesn't really help. We want it to be reported quickly after all the due diligence is done and assurance is provided. And finally, understandability. It's important that the information makes it easier for users to understand. If it's going to be complicated and makes it more difficult to understand, that's not really useful financial information, so it should be clear and concise. And another important thing to remember is the cost constraint. We need to provide a cost benefit to our clients. as accountants, we want to make sure that the information that we're providing is greater than the cost it's going to take to develop this information. So let's talk about a couple of basic assumptions and principles that we're going to need to move forward with this chapter. The separate entity assumption. We want it to be very clear that the financial statements that we are providing are separate from the owners. So let's say Jill owns ABC Corp. If Jill goes out and buys a personal car, this should not be reported on the financial statements of ABC Corp. That is her personal transaction, so we do not report the transactions of the owners. They are separate from the company. The unit of measure assumption. Accounting info should be measured and recorded in the national monetary unit. So, for example, in Canada, it should be reported in Canadian dollars. In the US, it should be reported in US dollars. In Europe, it should be reported in euros. The going concern assumption is that we assume that a company will continue to operate into the foreseeable future. We assume that the company will still exist next year. There are, of course, cases where a company is not doing well and they no longer are a going concern. We're not going to focus on that right now, so just assume, unless you're told otherwise, we assume that this company will continue to operate. And finally, the historical cost principle. This is very, very important for you to understand. The historical cost principle is that we record assets, so we record assets at the cost to acquire them. And this includes both cash and non-cash equivalents that were given up. So let's say, for example, we decide to buy a new building. So we have our new building here. So this is the new building. And in exchange for this building, we're going to give up cash of $50,000. And we're also going to give up a truck. And this truck is worth $20,000. So we've given up $50,000 of cash and the fair market value of $20,000 for this truck. So we would record this new building at $70,000 on our balance sheet, on our statement of financial position. It's very important to remember historical cost. The cost to acquire them, to acquire the assets, is the cost that it's recorded at. So let's start talking about the statement of financial position, our balance sheet. So, as we discussed in the previous lecture, the statement of financial position is built from your assets. And remember, an asset is what the company owns, and it is equal to the sources of financing. Liabilities, what we owe, and equity, what the owners have as their stake, their investment in the company. An important term to know for this chapter is liquidity. And liquidity is the ease with which an asset can be turned into cash. So how easily can it be turned into cash? So, as we said, a company is built of assets, liabilities, and shareholders' equity. So let's talk about these specific accounts. We have our current assets, and these are assets that can be used or turned into cash within 1 year. And they are more liquid, remember, they can more easily be turned into cash than our non-current assets. Non-current assets are going to be used or turned into cash in a period longer than the next year, so greater than 1 year, while current assets are less than 1 year. Current liabilities are obligations that will be paid or settled within the coming year. So just like with a current asset, a current liability will be settled in less than 1 year. And a non-current liability is an obligation that will be settled in more than 1 year. As for equity accounts, as we mentioned earlier, we have contributed capital, and this is cash or assets provided by the shareholders to the business, meaning this is their investment in the company, given in exchange for shares, parts of ownership. We also have the retained earnings, and these are the accumulated profits of the company that have not been paid out in dividends. They are reinvested and kept in the company to grow it bigger. So here is an exhibit from your textbook, and these are typical account titles. So if you look in our assets, we have cash, we have short-term investments, trade receivables, note receivables. And if you know something, as you go down the list, we have supplies, prepayments, buildings, lands. They are in order of liquidity. And this is really important. Your statement of financial position has to be built in order of liquidity, with the most liquid assets or liabilities at the top, with the least liquid at the bottom. So cash is always the most liquid asset because it is cash. And as you go down the list, you see they're more easily sold and turned into cash. So take a look. If you want, pause, read through it. But there's a couple of things to note. Anything that says payable is always going to be a liability. A receivable is an asset. So read through. These 3 accounts here are part of your balance sheet: the assets, liabilities, and equity. So what I'm going to do now is I'm going to draw a statement of financial position for you. Now I'm going to use some numbers, and don't worry, these numbers are coming from my head. They're not coming from any specific page or any other source, so don't worry. So the first thing that any financial statement must have is the statement title. So let's say that this is going to be called Sam Inc., and this is part of the title. So the company name comes first. Then we have statement of financial position, and we then put the date. So if you recall, the statement of financial position is a specific point in time. So let's say that this is going to be at the very end of the year, and every statement of financial position must say as at, because it is a specific point in time. So as at December 31st, 2016. If you want, you can put $sign that all the figures are in dollars. So we're going to start with the assets. So we'll begin current assets, and we just start to list them off in order of liquidity. So if you recall, the most liquid asset is cash. So the company has $15,000 of cash. They also have inventory of $10,000. They have rent prepaid of $6,000. And these are their current assets. So total current assets, $31,000. We'll then go down to their non-current assets. And the company has a building, and this building is worth $50,000. And we're going to say this is a new building, so there's no depreciation. Depreciation is a concept that you will touch on later on. Don't worry about it for now, but let's assume it's a brand new building. And that is their only non-current asset, so total non-current assets, $50,000. And we now add. So we're going to add our current assets and our non-current assets. And this is going to give us our total assets. So 31,000 plus 50,000, excuse me, is $81,000. So the total assets of the company is 81,000. Now, if you recall, the statement of financial position must follow the basic formula of assets are equal to liabilities and equity. For any asset that we have, there must be a source of financing. So let's do the other side of the balance sheet. We'll start with their liabilities. So let's say they have in current liabilities, they owe their suppliers some money. Remember, we had $10,000 of inventory. So they have trade payables of $5,000. So they still owe their suppliers some cash. And this is going to be their only current liability. So total current liabilities is $5,000. They also have non-current liabilities. And they have a bank loan. And they currently owe $20,000 on this bank loan. So their total non-current liabilities are $20,000. So just like we did before, we add our current and non-current to give us our total. So the total liabilities of the company are $25,000. We will now do the shareholders' equity section. So shareholders' equity. So if you recall, the two accounts that we have for equity right now at this part of the class are contributed capital, and that is the investment given by the shareholders initially, plus the retained earnings. So the company has $16,000 of contributed capital, and they have $40,000 of retained earnings. So this gives us total shareholders' equity of $56,000. So we add the liabilities, and we're going to add the equity, and this is going to give us our total liabilities and equity. So total liabilities and equity, and we have $81,000 total. So if you take a look, the assets here equal the total liabilities and equity. So if we were to look at the company, we can see every single asset that the company has, and we can see every single bit of financing. So why don't you take a second and just and ask yourself a few questions. How much debt does the company have? And how much do the owners have for themselves? So after you've asked yourself these questions, let's jump ahead to the next point. Business transactions. How do we record business transactions that will affect our balance sheet? So let's learn about transaction analysis. Transaction analysis is when we study a transaction to determine its effect on the accounting equation. If you recall, the accounting equation, assets is equal to liabilities plus equity, and this is the basis of our statement of financial position. So there's a couple of rules, a couple of concepts that must be true with every transaction. The first is that the transaction must affect at least two counts. So for example, it must affect, let's say, cash and inventory. If you're going to purchase inventory, you are going to spend cash, cash will go down, and inventory will go up. You have to affect at least two accounts for a transaction to happen. The second rule is that the accounting equation must remain in balance. So let's talk about our example of buying inventory. Well, the cash decreases our assets when it goes down, but we purchase another asset in exchange for it. So our equation remains in balance. The point is that we cannot create equity or assets out of nowhere. We have to know the sources of financing for the company. So at all times, just remember that transactions must affect at least two accounts, it could be more, and your accounting equation has to remain in balance. So let's run through a couple of transactions, and we're going to talk about how it affects each part of the accounting equation. So let's say, for example, we decide to issue shares in exchange for cash, $10,000. So our assets are going to go up by $10,000. What do you think is going to be affected, the liabilities and equity? Pause for a second and ask yourself. So, if you answered equity, you were correct. Equity would go up when you issue shares. Remember, this is the investment of owners. What if we then got some inventory on account if some of our suppliers gave us inventory through credit? So we got $5,000 of inventory in exchange for an increase in liabilities of $5,000. So just looking after these transactions, we have $15,000 of assets, and this results from $5,000 of liability plus $10,000 of equity. At every point here, the equation remained in balance, and it affected at least two accounts. But is this really realistic for a company to make a table like this where they're analyzing the cash and everything? It's not necessarily that realistic. So in order to deal with this, companies make journal entries and T accounts, and they have the entire accounting cycle. So let's talk about it. Every company has to run through the accounting cycle. So there's two steps. There's during the period. So let's talk about it. During the accounting period, a company will have transactions that happen all the time. And the first step is we analyze these transactions. Which accounts were affected? What actually happened? After we have analyzed it, we then record journal entries to the general journal. So we record journal entries after analyzing the transactions. And after we've recorded it, we post it to the general ledger. And the general ledger has all of the accounts of the company and records it all. At the end of every period, we then record adjusting entries. And you're going to learn about this in Chapter 4. We then prepare financial statements. And after our financial statements are prepared, we close temporary accounts. So we close temporary accounts. And these are closing journal entries. So basically what we do is we take our revenues, our expenses, our gains, and our losses, and we close them to our retained earnings. So the whole point of journal entries and T accounts is it really makes recording all the financial information of the company a lot more simple. So let's learn how to do this together. I'm sure at this point you've already heard all about debits and credits. Don't worry, very simple. Debit literally just means left. It is the left side that is being affected. And credits means the right side is being affected. And a journal entry is a bookkeeping entry to record the effects of a transaction on the entity's accounts. That's all it means. So remember, debit is left, credit is right, and a journal entry just records the effect of a transaction. And if you recall, the two rules that we have is that at least two accounts should be affected, and our equation must remain in balance.